In 1951, Warren Buffett was 20 years old, and he had already found the company that would be his greatest investment that he ever made in his life. In 4 different time periods in 1951, he bought shares of that company, and it represented at the time more than 50% of his net worth. 1 year later, it's 1952, and Warren Buffett makes perhaps one of his biggest investing mistakes. He sells his whole position. Hello everyone, my name is Green Bean, and today I'm going to be talking to you about the company Warren Buffett calls his favorite child. This company is called GEICO.
GEICO, a 15-minute call could save you 15% or more on car insurance.
And by the way, if you want to be Warren Buffett's second favorite child, please slap that like button and subscribe to the channel. Now, the 1930s was a very difficult time for everyone in America. I mean, the Great Depression did happen in 1930, so it was pretty bad for everyone. Food was expensive, cost of living was super expensive, and one of the things that was really taking up a lot of people's budgets was their car insurance. In the midst of all this, a couple by the name of Lillian and Leo Goodwin came up with a brilliant idea to save some people some money on their car insurance.
Leo Goodwin was restless. He set forth in 1936 to pursue a dream, to organize and found his own company. The insurance industry would never be the same.
Now, the business model for GEICO is super simple. Instead of like every single insurance company trying to insure every single driver, the founders of GEICO had a very good insight, which is certain groups of people are going to be less risk than other groups of drivers. And they identified the people who had the lowest risk of getting into an accident as government employees and military personnel. So they focused exclusively on serving that market, which is why GEICO is actually short for Government Employees Insurance Company.
The Government Employees Insurance Company, known today as GEICO.
So by focusing on that narrow niche of people who are low risk, because they have a lower risk of getting into an accident, they can price their insurance premiums around 30% cheaper than their competitors. And this eliminated the need to have insurance people market your products, because you can just market it as such a big discount from your competitors that you don't even need to sell the product. The product just sells itself.
Mr. Goodwin Sr.'s concept was different from other insurance companies when he formed GEICO, because he eliminated the middleman. There were no commissions, and therefore he saved the policyholder up to 30-35%.
Over the next 10 years, the company becomes super successful, and the founders and its early investors, they all become millionaires. So around 1948, some investors decide that it's time to cash out and have a party in the Bahamas. So they sell their stake for about $700,000, or roughly $9 million in today's money, to a group of new investors led by somebody named Benjamin Graham. And if you're asking if it is the Benjamin Graham, yes, it is. Now, in 1951, Warren Buffett is a humble student at the Columbia University, already had a pretty decent fortune of about $250,000, and he got super interested in GEICO because he idolized Benjamin Graham, who was actually his professor at the time, and he found out that Benjamin Graham was the chairman of the board at GEICO. So he travels all the way to GEICO, speaks with some of the employees there, VP actually by the name of Lloyd Davidson.
I was then a student at Columbia University and had gone down to Washington early on a Saturday morning to learn something about a company called Government Employees Insurance. A week earlier, I'd never heard of the company, later to be renamed GEICO, but in a visit to the Columbia Library, I learned that my hero, Ben Graham, was its chairman. When I arrived in Washington on that Saturday, I went to GEICO's office and was distressed to find out that the doors were locked. Unlike the Omaha of the 1950s, Saturday wasn't a work day in Washington. But I pounded on the door, and finally a janitor let me in and directed me to Davy, the only other fellow working that day. Davy had no reason to talk with me, but I told him that I was a student of Graham's, and he then spent 4 or so hours answering unending questions about the insurance industry in general and GEICO specifically. Davy couldn't have been more helpful to me that day and for decades thereafter. It really changed my life.
And he learns a lot of interesting things about the company that makes him super, super excited. So in the next year or so, he puts half his money and more into the company. Now, the amazing thing about all this is Warren Buffett wrote down all the reasons he made the investment in a newspaper article called GEICO, the security I like best. And if you guys want to read it, I highly recommend it. I linked it in the description for you. I'm going to summarize the brief investment thesis that Warren Buffett wrote down. So, GEICO, by insuring low-risk people, such as government employees and military personnel, they have to pay out less claims because these people, by definition, are less risk. And also, they don't have to pay any insurance agents to go and market their policy because their policy is so much cheaper than their competitors. And because it's so much cheaper than their competitors, they don't have to spend money trying to get new clients after existing clients leave for a different insurance policy because GEICO's always going to have the cheapest insurance policy. This means that compared to their competitors in the auto insurance space, GEICO had much higher margins and much higher returns on capital. And this means they had a lot more money left over that they can use to market themselves above their competitors. And also at the time, GEICO was only licensed to provide insurance in 15 states. And even within some of those 15 states, they weren't well established yet. So they had plenty of room to grow because if they expand to 50 states and a bunch of people want to save money on insurance, their runway is really, really far. And the best thing about all this is GEICO at the time was only trading at 8 times earnings, so it was really cheap. And that was because all the different insurance companies at the time had experienced some kind of recession as a result of inflation and other factors. So as a result, GEICO was really cheap and provided a huge margin of safety for any investor who wanted to enter into the position. Now, 1 year later, in 1952, the stock for GEICO goes up 50%, and Warren Buffett makes probably one of his biggest ever mistakes. He sells his whole position to buy another insurance company that was also trading for cheap, but he made a big mistake. And in 1995, he writes wistfully, if he had just held on to his GEICO position, it would have went up over 130 times in the next 20 years. Decades later, and many, many investments after, Buffett would get a second chance. In the 1970s, GEICO had become really successful, and they kind of started to suffer from the too big to fail syndrome, which is when a business gets really successful, they forget what actually made them successful in the first place. So they start deviating from their business strategy and start insuring everybody, not just the low-risk people, and they start drastically miscalculating how much money they needed to keep in reserves to pay out claims. And in the 70s, there was inflation as well, so the money to pay out claims was higher, and they couldn't actually get more money from their customers because they weren't allowed to raise their premiums in time. So in the 1970s, actually 1976, GEICO is on the verge of bankruptcy.
I declare bankruptcy!
So this is where the story gets good. Buffett was on the board of directors at the time for GEICO because he had some connections there, and he knew someone named Kay Graham, who was the CEO of the Washington Post, who Buffett was actually probably sleeping with, and she ended up giving him a connection by the name of John Byrne. Now, John Byrne is later known as the Babe Ruth of insurance. This guy was really damn smart, and Buffett put him in charge of GEICO, and he also worked with Salomon Brothers, who you might have heard about. That's a story for another day, but he worked with Salomon Brothers to inject $100 million into GEICO, keeping it afloat, and Buffett took a 33% position as a result, which was on the cost basis of about $40-some million. Over the next 2 years, John Byrne executes probably one of the greatest ever business turnarounds. He goes and makes GEICO profitable within 2 years by cutting all of GEICO's unprofitable businesses and purchasing reinsurance for their bad policies and turning the business back to what made them successful in the first place, which was to insure low-risk people. And it was a very good turnaround. 1995, Buffett buys the entire company, and in 1999, they released the Gecko ad, and it's all history from there.
Mr. Gecko. This is my final plea. I am a gecko, not to be confused with GEICO, which could save you hundreds on car insurance. So stop calling me.
GEICO. A 15-minute call could save you 15% or more on car insurance.
Is there any other large casualty insurance operation in the world that you know of that you would trade for ours?
No, not remote. No, nothing close. I mean, however we lucked into it, we have an unbelievable insurance operation, and I mean, GEICO is fabulous. And if you think about since 1936, the idea has been out there, but with all the strength that all the other companies had and the agency plants and everything else, GEICO has now moved to where it's the third largest in the United States and gaining ground every day on the two ahead of them, and doing it very profitably.